Welcome to the daily update, where I'll go over the action in the market for Wednesday, March 20th, and then we'll see how things look for Thursday, March 21st. Man, the market seemed to really like what Jerome Powell said in his press conference. They also liked that when they looked at the data that the Fed releases, that they still see the possibility of 3 rate cuts in 2024. Of course, there was some back and forth going on, but essentially we hit a new all-time high. It was like one of those everything rallies where pretty much everything went up. Now the market over the next day or two will have to work out some kind of equilibrium, and value really outperformed growth, and just see, okay, where do we go from here? We are becoming more overbought, not so much in the short term. We're getting a little bit more in the short term, but it's really becoming more pronounced in the intermediate term because we've been chopping sideways and we see some kind of a big move up or down, and that can really impact some of our more intermediate term charts. And we're still looking rather extreme in the long term. But at the same time, there's two ways to look at that. Yeah, we've gone up too far too fast. That's kind of the negative side. The positive side is that's showing really good momentum, that when a market gets extreme the way it is, and then it can stay there and still continue to go up, especially when we're breaking out of this range that we've been in lately. But we want to be respectful of that, knowing that, okay, this was more of a euphoric type of reaction to what happened. There was a lot of anticipation building up to the press conference specifically, and we shot to new all-time highs, not only in the S&P, but in other indexes as well. And then as emotions start to fade a little bit, and then some more reason, if you can call it that, comes back into the market, we'll see how, okay, how are they going to shift going forward from here? One thing that is kind of a negative about Wednesday's session is we were below average with volume, and to shoot to an all-time high on below average volume in a real anticipation of some event that was happening, that's a warning sign to us. Please note that I did post on Monday a video that goes over the proposed program that I hope to be launching in June or so. And I'm going to be posting more videos. It's going to be kind of like I don't know, a cereal, not that you eat for breakfast, but here's like one part to explain the program, and then here's a little bit more of why I do the program that I do, and then I may go off in different areas. It's not just a blanket repetition of things that I've said before, but it's rather involved. And so I want to give folks that are possibly interested in the program as much information as possible. As I create these videos, I'll be also making a playlist on the YouTube channel, so you can just kind of go in and boom, 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 watch them one right after the other, since together they'll tell more of a story. All right, let's go back and talk about what happened. It was really quiet, and that was not a surprise. We had a flat open, and prices stayed pretty close to the unchanged level. We went a little bit above, then we came back down. Everybody was just waiting. Then we had the announcement, and prices took this as positive. They quickly climbed above R1 at 51.92. We got above R2 at 52.12. So now we've climbed above the 5,200 level. Isn't that silly? Last January or so, there were folks predicting that the S&P would hit 5,200 by May. That just seems ridiculous, doesn't it? Well, here it is March, and we've already done that. We did hit resistance at a round number right around there at 52.25. Prices then dropped back down to R2 and then rose back to close almost at the high. We were up 0.89% on below average volume. That is a concern. We have to see if volume starts to come back in after this. We are positive with our technicals. We are looking overextended, at least on all the different time frames. So but we can stay this way when it's a good solid environment. We just want to be aware of this. The inflation and interest rate scenario, despite CPI and PPI coming out last week stronger than expected, it seemed like we were shifted back more to this Goldilocks type of scenario, and there wasn't a real lot of negativity. that was brought out in Jerome Powell's speech. At least that's what the market decided to focus on, the Goldilocks side of things. Some comments. This was what we call more or less an everything rally. Yeah, there were always things that go down. It happens that way. But we also want to know, or at least be understanding that, is this some kind of a blow off top? That's what happened in 2000. That's what happened other times when we just skyrocket up. There's like nothing that's going to hold this market back. When we have everything firing in the same direction at the same time, that's when we start to get concerned. Doesn't mean it's going to happen right away, but we just want to be aware of that. Remember, we look at three things at the same time. What are the chances of the market going up? What are the chances of it going down? And what are the chances of it going sideways? And we want to keep all three of those things in our mind at the same time. That's why when we're going up, I tend to look for more negative things. When we're going down, I look for more positive things because we tend to lose sight of those. All right, the S&P did rise above 5,200 and set another closing all-time high, and other indexes did that as well. And then here's another acronym for you, the Fed funds rate, FFR. They left it unchanged. And then another report that's becoming more and more important is the Summary of Economic Projections, or SEP. It showed that there's still an anticipation of 3 rate cuts this year, and that's what the market really liked. And then Powell kind of hinted along the way, since June of 2022, the Fed's been doing something called quantitative tapering. And that's where they bought all this stuff during the COVID lockdowns to try to stimulate the economy. And then in June of 2022 said, well, we're just going to let those things start to drift off of the balance sheets. And be careful, because this is like a double negative. They're going to possibly stop doing that, which means they may come in and start buying things again. And that could also prop up the markets as well. Then in the short term, we have our 20-period exponential moving average, the Williams percent R, which has been on the list for a while, the CCI 14 and 20, those are new additions, and our stochastics. Some of the other indicators aren't quite there yet, but another day or two to the upside, and we could have a full list of short-term extreme positive indicators. We are getting a little bit longer here in the intermediate term. We have our 50-period exponential moving average. The standard deviations chart, we're up into that +3 channel now. The Erin indicator kicked into gear and is giving us an extreme reading. The oscillators that we look at, we're still getting extreme readings. They're trying to turn up, but they haven't quite crossed above their moving averages yet. The bullish percent index is still above 70. It really didn't participate that much, and I'll show you that chart. The Sean trend meter, and we have the percent B. That means we closed outside of the upper Bollinger Band. That doesn't happen very often, and when it does, it tends to not stay that way for very long. And then our 10-period new high, new low study for the S&P. Also, our longer-term moving averages, the 150 simple moving average, as well as the 200 simple and exponential moving averages. The current scenario, the only thing I've changed here is that, okay, it looks like May's not really going to happen now, especially with that recent CPI and PPI. Now, maybe it'll start to happen in June. And we saw a bit of a change. And I go over those probability charts in the weekend videos with what's the likelihood of rates being raised or lowered. The dollar was down and interest rates were also down. We're still pretty high here. We're at 4.27% for the 10-year yield, but we are coming down. We're still inverted with the yield curves, and sentiment is still below 75, so we're not extreme. But we did close at 73, where we had been at 70. We are positive with our trend, but we're not really turning up. We're trying to with the short-term chart, but we're still below the moving averages in the intermediate and even in the short term. But we're still above 20, suggesting that we are in a weakening, positive, trending environment. Our bias is positive with the up day, and now I've switched our momentum over to positive because we are definitely looking more positive again for right now. We just had this kind of forgotten thing that happened, the weekly MBA mortgage applications index. It was down 1.6%. Last week, it was up 7.1%. And this isn't a major report. I just like to keep an eye on what's happening because buying and selling homes is a big part of the U.S. economy. And we want to keep tabs on what's happening with the mortgage applications. Here's a chart where we had seen an increase, even though it dropped off last week. Now it was actually negative in the latest reading. Here's some interesting charts. Here's Isabel Net. This is the truck tonnage index. The takeaway from this, even though for a long time the two lines were pretty close to each other, the big thing is, are they tending to go in the same direction? The purple line is the S&P. The yellow line is the truck tonnage index. Try to say that fast 3 times. And this is having a tendency to go back up. That means they're buying big trucks here. And even though the transportation index is just kind of off on some other planet, we are seeing a little bit more trucks being bought. And that's usually positive for the economy. And then looking at the secular bull market presidential cycle, and this, I'm just going to show it here. I've been going through this near the end of the video with our seasonality. But when we look at the light blue line here, let me go down here to the dark blue. These are all the presidential cycle during the first term, and that goes up. And then all presidential cycles, that's the light blue line. When the president is not in their first term, it goes up. And then the yellow line, that's what I was trying to hone in on. This is the all presidential cycles, that goes up. And this is what we're doing right now. And this is what tends to happen during an election year, whether it's the sitting president running for re-election, whether it's a lame duck president, what have you. Election years tend to be positive for the market because there's this hopeful anticipation of change. And this applies mostly to gold, and gold set a new all-time high too. And you've got a lot of the gold folks that are just, hey, I told you. Well, they've been saying this for 20 years, and now it's finally starting to happen. They're singing the old Frank Sinatra, Fly Me to the Moon song. But central banks, they're really buying a lot of gold right now. This helps their currency if they have something actually behind it. And as gold has been going up, they're still continuing to buy, and that may be pushing some of the prices up as well. And then this has been a change because it seemed like inflation was under control, but according to this, and this is before the Fed meeting and the press conference, the market was getting most concerned about higher inflation, and that mostly was with CPI and PPI coming out last week. Geopolitical things, well, you wouldn't really know that because I list a lot of the geopolitical things happening, and the market doesn't really seem to be paying attention to all that. But the takeaway from this chart is that inflation is becoming a concern again. We'll see the next time we see this chart if that ends up changing. And then the risk appetite indicator, it's going up and not necessarily giving us a really extreme reading now. And again, all of these are before the Fed made their announcement. And then U.S. new private housing units authorized by building permits and recessions. When we tend to top out and then come back down, that's sometimes when we see a little while after that when we go into a recession. And so we've been going up. This has been looking fairly healthy lately. What we're going to watch for is if we start to see a decline, this could be one of the things that we watch for to see if we end up actually going into a recession. And then here's one interesting chart. And this is why I do not post on Twitter. I spend some time on there, but I'm mainly just looking at all the crazy things other people say. I post whenever I do a video. Okay, so when I post to YouTube or Rumble, there's a link. But I've got, I think, 20 followers or something on Twitter. I like to just look at what other people are doing. For me to express my opinion is not that important, but try to tell that to the average Twitter user. And this is the stuff I follow just has to do with the stock market. My goodness, there's other areas I could get into that's even crazier. But this gentleman, and I don't follow him, I just happened to run across this tweet. It said, in the history of modern finance, no single indicator has done a better job of predicting the next global recession that it will start than when the Bank of Japan starts raising rates. And that's what they did. And it says full of proof. And you can see a chart here. This is when they started raising rates in these shaded areas. That's when we went into a recession. Okay. Well, he meant this to be funny. Well, when you read words and you've got people that are with their nose into their phones, that maybe the only human interaction they have is with Twitter or Instagram or something like that. This guy just got lambasted. And the last thing I want to do, I mean, I don't really get hit all that hard with the videos that I post, but every once in a while, a crazy person will drift into the picture. And that's why it's like then he had to come out and post again. I'm always surprised which tweets gain tractions and which don't. I wrote this tongue in cheek. This was a response the next day. Obviously, there's no casual link between Japan raising rates and the rest of the global economy going down in flames. It's just that Japan has a habit of hiking rates towards the end of the business cycle, which is arguably where we are now. And that's part of the debate here, if that's where we're actually at. He was trying to be clever. He was trying to be funny. But man, if you read through the comments on this post, woo-wee. Oh, man. All right. Intraday. So we were really slow and this was pretty much expected. We just kind of went below the unchanged level. The market was waiting for the announcement in the press conference. And the market knew that they weren't going to raise or lower rates. It was what was going to be said. That's what was the real anticipation. And they liked it right off the bat. We saw the gyration, but overall, we went up above R1. We got up above R2. We topped out at around the 52.25 level. Saw a little bit of selling here, and then right at the very end, a whole lot of shorts having to buy to get out of the market probably, and this kicked us right back up to close pretty much at the high for the session. Here's the intraday chart, very quiet ahead of the FOMC meeting announcement, and then the skyrocketing that took place after that. And we did see value actually do better than growth. They both were up, and so that's positive. But when we look at some of our ratios here, we were up with growth, but we're not breaking out. We're still pretty much range bound here with the S&P growth to value ratio. And then end of day, we were up with growth more than we were with value. The mid caps were up less and the small caps were up less. So when we look at our charts, we're starting to come down here with small cap growth to value. Something just to be aware of. We like when this is going up, even though the small caps are just not doing all that well. And the index did really well. But if this keeps going down, that's going to be a bit of a concern. We saw a little bit of a tick up with the mid caps, and the mid caps are doing better. They're just coming off of setting recent all-time highs. In fact, they may have closed at an all-time high here. It looks like maybe on a closing basis they did up here. And then we did decline with the S&P growth to value ratio on the daily chart. It is coming down. We'll have to see over the next session or two if this can turn and start to go back up, or are we going to see more weakness coming down? Like I said, this was one of those everything rallies. So a lot of the value stocks that have been more under pressure, they saw a little bit more love. And we came up a little bit with our discretionary to staples. Now, discretionary, that's more growth oriented. And when the economy is growing, discretionary will outperform staples, where staples are things that you have to have, even if the economy is not doing so well. And both of them are going up. We have discretionary going up and staples. And I incorrectly said this a few days ago. This is a golden cross with the staples equal weight ETF. But what we want to see is discretionary outperforming. And yeah, it's improving, but it's not really breaking out. And then large cap growth continues to do well and is setting all-time highs here when we look at it in isolation. Looking at our trend, not really much. We're just kind of drifting lower with our overall trend, but we are positive. We turned back up with the green line here. And we're going up in the short term. We're trying to turn up with the moving average, but we're not quite above the moving average yet. And we did drop off with volume. A really highly anticipated day, a market-friendly type of an environment, and volume is below average. Now, that could have come earlier in the day, but we've seen Fed days that were above average with volume. Looking at sentiment, this was finally updated. We not only went above 3, we're now above 4. And now this is about a week old or so when we look at investors' intelligence. They're getting pretty extreme here. We could still go higher than where we're at right now, but when we start to get really high readings like this, we go with it as it's going up. But when it starts to get extreme, then we look at, okay, maybe we've topped out and this could start to come down. Looking at the VIX, where it finally dropped below this recent upward trend line that we have of setting higher lows with the line chart, and we did drop with the VIX this way. And with the up day that we saw, the volatility of the VIX dropped as well, looking at the bar chart as well as the line chart. And we're starting to come back down with the momentum. When we look, we use a MACD where we've been seeing a general uptrend of the VIX lately. We'll see if this can continue. Is the VIX going to continue to fall? And this is interesting. Even though we had an update, there's a lot of added hedging that's going on here. The equity put call ratio, it was up in Tuesday's session. It was up again in Wednesday's session, even with the market hitting a new all-time high. There's some folks out there that are afraid that this is possibly some kind of a blow off top, at least in the short term. Now, we don't know that, but there are some people that are afraid of that. And so they're doing more hedging. That means they're buying more calls than puts, and they have long positions and they use puts to hedge so that whatever you lose in your long position, you pick that up in the put position if something goes down. And then we're starting to turn back up with our 5-period simple moving average of the equity put call ratio. We did decline here with the volatility risk premium with the update. This is starting to drop below the range that we've been in. So it just shows that the risk premium is quite low now. Our advanced decline line, we are breaking out based on price. We're also breaking out based on volume. That is looking healthy inside of the S&P. And we're pegged at the top here with the new highs. We saw a real explosive growth of the new highs because we're in territory we've never been in before. The 10-period is starting to turn back up. So this is another internal measure that is looking healthy. We're also going up with the advanced decline ratio, and that's looking healthy as well. The accumulation distribution did turn back up after almost coming down to the moving average. We didn't see much of a change here with the Chaikin money flow. It's up and it's positive, but it's not really breaking out at this time. And we're going back up slightly with the Chaikin oscillator. This is looking good. The cumulative S&P advanced decline line based on price, we're setting all-time highs, and we're seeing more confirmation now when we compare it with the cumulative volume. We're also looking good with the NYSE cumulative advanced decline line. That's really shooting up. Our regular advanced decline line is also confirming that for now. And this is a different measurement of the NYSE advanced decline line. It's also looking a lot more positive. And then we look at common stock based on price, and that's being confirmed by what we're seeing based on volume. Not coming back to previous highs yet, but still showing an improvement. When we look at our advanced decline line studies, we are looking better with the NYSE common stock, the S&P. We're breaking out finally with the mid caps. We're not breaking out yet, but showing some improvement here with the small caps. Here's our daily chart. We were able to get above and close above this pivot line. This is what I pointed out in yesterday's video. This pivot level, it's like we were hitting that and bouncing down, hitting that and bouncing down. The fact that we got above this and closed above this, that is positive. But on the bottom, we dropped to below average with volume. The Williams percent R is extreme positive. Now, it can stay this way for long periods of time. Doesn't mean, oh no, my gosh, we're going to tank. It might mean that, but at the same time, it just means that the momentum right now is really strong. We are looking extreme with the CCI 14 as well as the CCI 20. And again, these can stay up here for a while. We are looking extreme with the boom indicator. We're getting kind of far away from the 20-period moving average, so that's giving us an extreme reading. We're also getting kind of far away from the 50-period moving average as well. We just saw, compared to what we've been seeing lately, when we break out of a range like we did, that is showing a rather extreme move, and we're still looking more positive with the 200-period moving average study and not necessarily extreme according to this chart here. We just want to keep an eye on the 20-period moving averages. If we start to see some weakness, we want to watch this as potential areas of support. Just barely getting extreme with the 20, 50, and 200-period exponential moving averages. Getting a little more positive and going back above the midpoint with the force index. We're looking extreme with all of our stochastics charts in the short, intermediate, and long term. We're up into the +3, just barely. So we're just a little over the border now with the +3 standard deviations channel. And then intermediate term, the balance of power is looking more positive. And I wanted to show the double and triple exponential moving average. We were able to come back above the red line. That's the triple exponential moving average, and that moves faster. And when the red line's above the blue line, that means the trend is stronger since it goes quicker. And we were able to close above both lines, and the more intermediate term trend is still solid in an up position. We are positive with the go, no-go system with the darker blue bars. We are finally starting to break out with our highest high value and setting new levels there. TTM squeeze really isn't kicked into gear yet. We still are positive, but we're seeing the darker blue bars here. We did turn up with the ease of movement, and the Erin indicator starting to give us back more of an extreme positive reading. That's because we saw the green line just shoot up. We're seeing the buyers are in control, but they're pegged at the top as sellers are really falling off. And when we compare the two with each other, that gives us an extreme positive reading. We are still above zero with the McClellan oscillator for the S&P. This is 2 days now that we've seen this. So this is helping our summation index based on price to turn back up, and we're turning back up based on volume. So the McClellan oscillator, this is more short to slightly intermediate term, where the summation index is more intermediate term to somewhat long term. And then we look at this on a broader basis with the McClellan oscillator for the NYSE, where we are above zero yet again. And so we're starting to turn back up based on price and volume. So broader market, we're looking better as well. We did turn back up with the Swenlin trading oscillator based on price and volume, and we did cross back above zero. This is turning back to positive. But when we look at our oscillators, we're getting an extreme reading here, and we turned up a little bit, but we're still below the moving average. However, looking at price and volume, we haven't crossed back above these moving averages, but we are seeing, I guess maybe we did based on volume. So we are seeing some improvement here. We saw some improvement with the PMOs that are rising. We're turning back up with the buy signals. We actually declined a little bit, but we're extreme positive with the PMOs that are above zero. The Elder's Impulse system is still positive for the S&P. The parabolic SAR is positive. The slope, it continues to decline and is no longer giving us an extreme positive reading. But remember, oscillators, they move a little slower and they're moving average based, so it can take them a little longer to kick in, even when you're using something like the slope oscillator, which is our touchiest oscillator. We are turning back up slightly with the MACD, but we have not crossed above the moving average. So we are seeing some improvements in the short, intermediate, and long term, but not enough to really turn us back positive. The warning from this as well is if we do turn back more positive, we're getting still extreme readings from pretty much all of these oscillators. It doesn't give us an awful lot of run room before we start to possibly look exhausted. And we're also seeing longer term negative divergences. Now, some of this is how these things are calculated, but there's millions of people that watch these things and they see this and they make decisions based on this, thinking that, yeah, this is a negative divergence, not realizing that it's partly due to how it's calculated. We are still above all of our plotted moving averages, and we actually didn't really show an improvement that much. We were up slightly with the bullish percent index, and we're still above 70. Setting an all-time high, breaking out of a range, we would expect the bullish percent index to be more improved than it was. We did turn up with the NYSE bullish percent index, and that's still positive. We're just coming back up to 50 now. We're slightly turning positive here with the NASDAQ 100 bullish percent index. The money flow ticked down just a little bit, but it's still above 50. The ultimate oscillator is positive. We're turning back up with the vortex, but we're still seeing this overall weakness since the beginning part or so of February. Still looking okay with the RSI 14 and 9. We're just a little bit below being extreme with the 9-period RSI. We continue to bounce up with the on-balance volume. We're bouncing off of that moving average. The stocks above their 20-period moving averages inside the S&P continues to show improvement here. We're also showing some improvement with those stocks above their 50-period simple moving average. We're still looking good with the 100-period moving average study. This is, yeah, it's extreme, but it's also showing good momentum. And we're also extreme, but showing good momentum when we look at the 200-period moving average study. Copy curve, it's still negative, but it is trying to turn up. We're looking extreme now with the Sean trend meter. And here's the percent B indicator. We closed outside of the upper Bollinger Band. That does not happen very often. Now, it doesn't necessarily mean we're going to turn and go the other way. It could mean that. But at the same time, these Bollinger Bands will readjust, and we could continue to hang on to these gains and see the Bollinger Band come up and then actually see the percent B go back inside or back down below, giving us an extreme positive reading. Our different charts on a trend basis, we're looking positive. The Heiken Ashi is positive. The Kigge chart is positive. The Renko never did really change. And the 3-line break is positive as well. We have a new X drawn in here with the point and figure chart with setting the new all-time high, but we still have this kind of negative warning here, the long, tall up that was triggered on March 7th. That just means there's an awful lot of X's going on here with not many O's happening. Long term, and again, this is really a short-term chart. We were able to get back above this blue trend line here and recapture that as we're breaking out just slightly. And we'll have to see, maybe March 21st now will be the beginning of the new 50-day cycle. Sometimes this means something. We've looked at times when this marked a top or a bottom. The market's looking pretty extended right now. Is this going to be about the point when we see some kind of a change? Maybe, but I don't use this chart to make decisions. I just use this to be aware of what's happening. And we're still above this longer term. Now I'm calling it resistance. The longer we stay above this, the more this could end up acting as support if we do end up seeing some weakness. We're still looking extreme with the 150 and 200 period moving averages. And we're back to straight positive now with the Keller market model. All the different indexes, all the different time frames are positive. And we saw a lot more blue or green than we did red in Wednesday's session. In Canada's even, man, party time there. The S&P sets a new all-time high. A lot of things were quite positive. And the equal weight is hanging in there too. It enjoyed some of the love in Wednesday's session as well. And so the ratio between the two, it ticked up a little bit, meaning the mega caps slightly outperformed, but they were pretty much even with each other. The Dow is coming right up to this R1 level. So boom, we have some more overhead resistance that we've not cleared yet. We are positive with the diamonds when looking at the Elder's Impulse system, and we're coming right up to this. These, in my opinion, have become important. We can look back at other times when we hit these pivot points, and they can act as either support or resistance. We're just a little bit under this R1 level for the NASDAQ. It would be much more positive if we could break above that. Until we do, we have to treat this as possible overhead resistance. We're still a little further away with the NASDAQ 100, but we still have an R1 level above where we're at. So far, this pivot level down below has been providing support. And we're still positive with the QQQs when looking at the Elder's Impulse system. We're still negative with our momentum, but we are turning up. But the PPO is not crossed above the moving average. We've recaptured the 20-period moving average. We closed right on it in Tuesday's session. Now we're back above it. And that's a positive thing whenever you get above a moving average. Small caps even saw a little bit of love. We'll have to see how much they give back of this. We're back above the pivot point. We're back above the 50-period moving average. And we've switched over to positive with the small caps when looking at the Elder's Impulse system. We crossed above 50 when looking at the Russell 2000 small cap ETF. So that's turning more positive. We did see a nice solid update. The longer term trend is still up. We're negative with momentum, but we are starting to turn back up. The mid caps were able to break above this R1 level. And I guess they did set a new all-time high, but they didn't set a new intraday high. And they're positive with the Elder's Impulse system when looking at the mid caps. And looking at Google, it was up over 1%, still showing some improvement after bouncing off of its 200-day moving average and then finally clearing its 50-day moving average. Now, it shot up and has been coming back, but it was up in Wednesday's session. Apple is still in a downtrend, but showing some improvement, up almost 1.5%. Tesla was up almost a little bit over 2.5%, but still in a downtrend. NVIDIA still in a sideways range. It was up over 1%, but we're not really breaking out here, at least yet. FANG index did improve, but we're still pretty much in a sideways trend here. The financial sector was up over 1% and is now setting new all-time highs. The bank ETF is not doing all that great, but the financial sector is doing well. We were down with the dollar because interest rates possibly getting cut. That means dollars don't cost as much. And you tend to see dollar weakness when that happens. And looking at the S&P versus the world, where the red line, that's the S&P, which is now breaking out to an all-time high. We were pretty much flat with the world index. So the relationship kind of fell off a little bit, but longer term, it's still tending to get stronger. We were down with the 10-year yield. We were up with the 10-year based on price. And we're not really seeing a big improvement here. The Q's to S&P, when we look at growth to value, barely ticked up and is still below a declining moving average. Saw a little bit more of an improvement with discretionary, but still under a declining moving average. Just a little bit of a tick above the moving average when we look at large cap growth to large cap value. So with the large caps a little bit above the moving average, a little bit of an improvement here with the mid caps, and we actually saw a decline with the small caps. We're still looking positive with our 5-period moving average of the highs minus the lows across the Amex, NASDAQ, and NYSE. Still looking positive here. This is showing good S&P momentum with the 10-day average of the highs minus the lows just for the S&P. So what's our outlook for Thursday? We're still positive. We're becoming more overbought. We're above that overhead resistance, and we still want to keep in mind there's this thing called seasonality that tends to be weak right about now. Is that going to happen? It just really hasn't developed up to this point. We're going to get weekly jobless claims, existing home sales, the leading economic index, and then we want to keep an eye on all the weird things going on around the world. And then we won't have any economic reports on Friday. And here's Thursday's different readings, and they're what we saw last time. And if they have a forecast that goes with that, seasonally, we're not looking all that good for March 21st. We're negative with the Dow and neutral to negative with the S&P and NASDAQ. We are in the week after options expiration where we tend to be down more than up. We'll be on the 15th trading day of the month where we're just kind of sideways. Not anything really positive there. And we're wondering if this is ever going to kick into gear, this negative seasonality that we see on the previous chart as well as on this chart. Thursday is one of the more positive days compared to what we did back in 2023. We're also in this negative time right now that Tom Bowley has found, which is often when we see some kind of a pullback. And then the warning signs, the equity pull call ratio. It's like every day I'm having to change this thing back and forth. Now it's going back up. And this could be some hedging ahead of what some folks think could be some weakness. The Copic curve is negative, and then we have our list of negative divergences here. And we're potentially in some kind of weak seasonal time, even though it's just not happening. The parabolic SAR is positive. The vortex is positive. It is improving, but we're still seeing that gradual weakness when we look at it a little bit longer term. The NASDAQ 100 bullish percent index, it hasn't really crossed back above 50. It's right at 50 now. Small and mid cap growth are positive, but did show some weakness as we saw some value kind of kick into gear. Large cap growth is holding up, but also possibly showing some weakness. When we look at the ratio between S&P growth to value, the financial sector is positive and just keeps kind of going up here. So we're positive, but we're becoming overbought in the short, intermediate, and long term. We're above the overhead resistance, and we want to be aware of the potential of weak seasonality in the short term. And this is what I pointed out yesterday. We're above that short-term pivot point, and we're also above this longer-term overhead resistance there. And then in the intermediate term, we're becoming overbought, and we're also becoming even more overbought in the long term, but we're positive still in all three timeframes. Thank you. I hope you have a really good day, and I will talk to you in the next video.